the financial red zone, that's 5 to 10 years away from retirement, it's more important than ever to make sure your plan is in place. On today's show, we've got some tips to help shore up that game plan to help you score big in retirement. That and so much more on this episode of Elevate Your Wealth.
And now, Elevate Your Wealth with Mark Stimson and Casey Elkins.
Welcome into Elevate Your Wealth. Your hosts, Mark Stimson and Casey Elkins. You can find them right here in Seattle. Elevated Financial Management. Check them out online, efmnw.com. All letters, efmnw.com. A great resource website. You'll find their TV show and links to their radio show in podcast form. It's always about retirement. They've got 42 years combined experience in the planning business, and it's all about getting you ready for your retirement years. They're certified financial fiduciaries, and they put up with me. I'm Morgan Patrick, consumer advocate. So let's get into this. If you are among the millions of Americans that have realized that you need to save a little bit more before you actually retire, we've got some time-honored retirement saving tips, so we'll get to these. Casey, we'll start with you. The 401k, you have to absolutely positively fund it to the max.
You have to. I mean, there is no doubt about it. That's one of the biggest things that you can do, maxing out your 401k contributions. And here's really the key, doing it from a young age. Right now, most of our clients are not folks in their 30s, 40s. But if that is you, start contributing the max to your 401k as soon as you can. Think about it this way. If you're maybe contributing a certain percentage now and you get a pay raise, instead of taking that pay raise into your life and spending it, look to pay yourself first and invest that in your 401k. You've got to max that out. Get the match if you have an employer match. I mean, you are really missing the boat if you're not saving the money here like you should be. But to folks that are closer to retirement, right, the folks that we normally are working with in their 50s and 60s, realistically, you still can be contributing that max. Even if you're going to retire next year, contribute that money. The more money you get into your retirement accounts, the more that's going to help you. For right now, for this year, the limit's $22,500 is what you can put into your accounts. But if you're over the age of 50, you can make an additional contribution of $7,500. So that would be able to, you'd be able to get in $30,000 for the year. Just having that money in the account, saving that for retirement, allowing that money to be invested and growing, that is a big service that you're giving yourself, a big benefit that you're giving yourself, and something you don't want to miss out on.
Tell you, there's so many things that you can do, and these are time-honored things that, they're little things, but in the long run, they could really make a huge difference. So the next thing, and Mark, let's get your comments on this. Just look at your 401k and maybe rethink the assignments.
Yeah, this is crucial. Casey was just mentioning some things. We've got to think about how we are investing. Now, conventional wisdom is that the older we get, the more conservative we want to become. And it makes a lot of sense, but it's not always the rule. But again, our plans that we do here are really age-based. So as we get older, the conventional thinking was, well, we'll put more into bonds than into stocks. Well, that kind of backfired a little bit, especially last year. There was nowhere to run. Stocks were down and bonds were down at the same time, which usually that doesn't happen. And bonds can be a little worrisome when interest rates are rising, which is what's happening right now. And so there are some other asset classes that can help us still protect the money in that retirement red zone that we've been talking about. Because if you end up losing money because of market volatility and you're needing to pull money out, you're going to be locking in those losses, which is the worst thing that we can do. So we want to have different buckets to be able to pull from, especially if a prolonged bear market does occur, because we want to let those stocks or mutual funds bounce back, right? We want them to increase. So we don't want to be forced to sell at a loss. And something else to really think about is, what is your risk tolerance? Do you really know? Because everybody's situation is different. Some are more risk takers than others. And in a lot of situations, we always find usually the male is a bigger risk taker than the female. Not always, but a lot of the time. So you want to really find a financial advisor that's going to talk you off the cliff, the ledge when the market is doing like what it's doing right now, volatile each day. We're seeing stock prices change dramatically. The swings are unbelievable. And so, how you're diversified is going to make a huge difference. So, the point is, we need to have stocks and bonds no matter what we do here, but we want to do it with a plan. So, you need to work with somebody that's going to be able to help you, because the last thing we want to do is switch all the bonds when we're panicking and interest rates are going up. That could be one of the worst things that we could do. So you need to have a plan, but you need to do it in the right way. So that brings us to something that's really important, Casey, is what else can we do? What about adding maybe another IRA?
Yeah, if you don't have a 401k plan at work, this is a good option for you. You don't have the same contribution limits that you have in a 401k. You can put more into a 401k than you can in an IRA. But still, this again, the principle remains the same: saving that money, allowing it to grow, keeping it invested, and saving it for retirement. That's really the big key. So for this year, you can save $6,500 a year in an IRA. If you're over the age of 50, you can add $1,000 to that, and that really is a big benefit, again, because it's not about timing the market. I think we talk about this a lot. It's not about timing the market. It's about time in the market, right? You really have to give yourself that time to have that compound earning, and capture the growth over the years. And so it's something that you don't want to let slip by and not give it the proper attention or the proper place that it should have.
Opportunities, folks. I mean, these are things that you can be doing. Time-honored retirement savings tips we've talked about already. Fund that 401k to the max. Rethink the assignments within the 401k. Maybe take a look if you're already fully maxed in the 401k, or maybe you don't have a 401k. Maybe you add an IRA to your portfolio. And these are things that you can do. Now, I love what Mark said. I mean, working with professionals, having that ease of mind, knowing that you've got a plan in place, but knowing you have, it's like a retirement consultant working with you to get you to and through retirement. We have positions on the calendar with Elevated Financial Management. I'm going to give you a little bit of a teaser. We've got 10 appointments. They are complimentary. Again, these are for our radio listeners. You can call right now and grab one, 866-668-3625. That's 866-668-3625. So let's continue, guys. I mean, retirement savings tips, these are really, really well known. And we'll move to this. Now, when you think about the IRAs, there are two different kinds. There's traditional, and then there's the Roth. Mark, go ahead and dive in deep on these two.
Yeah. So this is something that anyone can do, especially if you don't or are not fortunate enough, let's put it this way, to have a 401k at your place of employment. So what you can do is you can set up an IRA, not only for yourself, but let's say your wife is a stay-at-home mom. You can set up what's known as a spousal IRA, even if you are the only one that is working or earning income. You can set that up so both of you can contribute to an IRA, which is really important, because that means you could double up and you could literally be putting away as much as $15,000 a year if you're over 50, if both of you have an IRA. But now that brings into question, what about a Roth? Well, I'm a big fan of Roth. I think Casey knows that. He is too. If you have a question come up about maybe one of your clients ask you, should I set up a traditional or a Roth? I will tell you, if it's my children, I'm going to go a Roth all day long, because all of that growth is yours over time, which will mean a lot more than the initial deduction that you can take on the year that you make that contribution. So I just love a Roth, because on the back end, when you take that money out, it's going to be tax free at that point. So, this is something you want to understand the difference. But the problem with a Roth for a lot of us in the workplace today, there are earned income limits that will limit your ability to contribute to a Roth. So you need to understand what those rules are as well. But something else I think we need to really think about is we got to know what to expect. How do we deal with that a little bit, Case?
Yeah, how aggressive you should be when saving also depends on your other income sources too, and what you can reasonably expect to have. So this is why we always encourage people to have their Social Security account set up online. Even if you're a number of years from retirement, set the account up now. Have an idea of what you can expect Be realistic with those numbers. What's your pension going to look like? We want to consider all income sources. And that will help you gauge as to maybe you need to be more aggressive in saving, you need to save more, or maybe you're already on the right track and you can continue what you're doing. But I can say this, you're never going to regret saving more for retirement.
Gentlemen, we are up against it. Let's open it up. We've got the 10 appointments. Casey, walk us through what's going to happen for these 10 callers.
Well, again, this is a written financial plan put together by our team of certified financial planners. What that really means is that this is a roadmap for retirement. So if you're 5 to 10 years from retirement, you've got questions about what that's going to look like. You want to understand what your incomes are going to be if you're invested properly. How are taxes going to affect you? Is there something that you can do to lessen your taxes? What's that healthcare piece going to look like? Have you dealt with long-term care? There's lots of pieces to the puzzle, but that's exactly why you need a plan. That's exactly why we offer it, because we're all about helping people retire and stay retired. So don't hesitate. Pick up the phone. Give us a call.
Phone number, here it is, 866-668-3625. 10 appointments, again, complimentary. Leave the checkbook at home. This is your opportunity to kind of see where you are in your process. And you may be in a situation where you've been thinking about it, but you've been putting it off. A lot of us procrastinate. I'm guilty of that too. But this is an opportunity now where you can just get off the couch and you can do this. You can take your head out of the sand and you have a complimentary appointment to get it done. 866-668-3625. But you also may be in the other situation where you've already started working with someone or maybe an advisory group. But, you know, the communication level's just not there. You have grown frustrated. Well, it's an opportunity to get a second opinion. Call it, grab an appointment. 866-668-3625. When we come back on Elevate Your Wealth, inflation taking a big toll on all of us, particularly those getting near retirement. We'll take a look at some changes you need to make to your plan to keep up with inflation and make sure your retirement is secure. It's coming up next. You can find them right here in Seattle. Elevated Financial Management, 42 years combined experience between these two in the retirement planning business, helping hundreds of their clients get ready for their retirement. They're certified financial fiduciaries. I'm Morgan Patrick, consumer advocate, and we go back and forth on so many different retirement topics. Very important to have a customized plan. There are a lot of you out there that have these wonderful portfolios and feel like you're going to knock on retirement's door and say, hey, here I am. You really need to plan this out. You need to work with fiduciaries. You need to have that roadmap to get you to and through retirement. And here's the really neat thing about this show. We offer up 10 appointments exclusive for our radio listeners, and these are no-cost appointments. These are complimentary appointments, and it's an opportunity for you to kind of get on track. And if you are off track or maybe you need a second opinion, one of the appointments can be for you as well. 866-668-3625, the number to call to grab one right now, 866-668-3625. So if you're on a fixed income, it's important to reevaluate your budget and make sure you can cover your expenses and still have a little fun. You guys were chuckling in the break. We do have a nice little quote. Due to the economy and inflation, my bucket list has now become a Dixie cup. And I tell you, it rings true. A lot of people are seeing this wherever they go. Prices are going through the roof. So, Casey, we'll start with you. You know, you got to plan for the costs of retirement, and it got more expensive.
It did. It definitely has, right? And I think really this ties back to something that we talk about regularly on the show, on the TV show, when clients come in. Retirement is unique to you, right? It really is your individual circumstance. And the reason I say that is because I'll give you a couple of scenarios. I have a set of clients that are retired teachers. They did very well saving. They've got great pensions, good Social Security. And realistically, what they want to do in retirement is garden, spend their time around the house, enjoy one another's company, spend time with their grandkids, which is great. But the reality is that's not a very costly retirement, right? There's not a lot of cost associated with that. And I have other clients. I had a client tell me recently that she goes on 6 cruises a year and she wants it to be 12. So the reality is that everybody lives a different retirement. And so how much you need to save is also dependent on what you're going to do in retirement. There's not a one size fits all. We've heard a lot of people say, well, I need $1 million, right, Mark? If I got $1 million, I can retire, right? That's what I was told. Well, how much do you want to spend? If you want to spend $100,000 a year, $1 million ain't going to cover it, right? So if you're okay spending $10,000 a year, $1 million might be all right. So the reality is that you've got to understand what that retirement's going to look like and plan for the future, and then create a goal backwards from that. Now, the honest truth to that is that you're probably going to need help to do that, right? Somebody who can help you factor in for inflation and see what that looks like over the course of however many years saving for retirement, taking into consideration where you're at and how you're invested and all those kinds of things. But ultimately, that's what it boils down to, is what you want retirement to be and what it's going to cost to live that type of retirement. Now, again, Mark, really when it comes down to it, we've got to understand how we're accumulating in our retirement savings. That's a big piece of the puzzle as well.
Yeah. So once you set that goal, that's the main thing. Like Casey said, you got to start somewhere, right? So you need to set a goal and then start to try and achieve it. So once you figure out that you have a good goal, now we can really turn our attention to focusing on how can I reach my goal? What's a good way to do that? Well, I want to share 5 little bullet points with everyone that's listening today. Let's talk about the first one. Number 1, begin the plan early. Casey mentioned it's critical. You got to start somewhere, right? If you never begin, you'll never have, the pot of gold at the end, right? You got to begin somewhere. So start as soon as you can. Okay. You're going to do that, right? That's going to serve 2 important purposes. You're going to benefit from those dollars compounding. And more importantly, it's going to build the habit of savings, how important that is. Just get it started. So that's bullet point number 1. Number 2, you want to invest in tax deferred accounts, right? Not that paying taxes isn't what we want to do. Right now, we would tell you taxes are we're having a fire sale right now at the rate that we're enjoying and seeing. That's going away in about a year now. It's automatically going to sunset. It started 25. So we got to do some planning. Let's get going. Now, what can you do? So you could set up a Roth and a traditional account. As we heard us mentioned earlier, we love Roth accounts because all the investments are going to grow tax advantage for you. It's going to increase the effect of the compounding on those account dollars. And if it's a Roth, it's going to be tax-free on the back end. So that's number 2, invest in a tax-deferred account. Number 3, maximize your employer benefits. That's going to help you save. Right? If you do that, you're going to get, well, I call it free money. You want to take advantage of all my Boeing clients. They get a nice match from Boeing each and every month that they maybe are doing some dollar cost averaging, but you want to take advantage to accelerate the growth of that 401k. It's critical that you do that. So that's bullet 3. You maximize those benefits. Number 4, understand the impact of inflation on your goal. While the current surge in inflation we know is going to end at some point, even a normalized rate, some might consider 4 to be normal. That's still a little high in our book. We've been using about 2.5% for the last 25 years. And it's amazing what 2.5% causes 10 years down the road. So you want to have a plan for inflation because it is going to impact the dollars in the future and how much they'll buy. So understand the impact of inflation is 4. And number 5, connect with an advisor. We can't overemphasize how important it is because if you get an advisor, especially that can help us with the decumulation phase, we're going to help you monitor what's going on inside your plan. Do we need to make any adjustments? But we can also help track things that are going to happen inside your plan. Casey mentioned earlier, life happens, right? Every plan doesn't go as we set it up. I can tell you, I just had a client recently that had cancer come out of nowhere, so we had to change everything. So you got to connect with an advisor. But those are 5 really good ideas that can help you really maximize your savings at this time.
I mean, think about it, folks. I mean, we are all about retirement planning and just going over, because of inflation, things that are happening, it's going to impact you as you move towards your retirement. And so your plan should be ready for it. So make sure you're taking some notes. We'll give you an opportunity to get on the calendar with Elevated Financial Management at no cost, no obligation, no pressure. And you can talk about your situation. The number to call to grab an appointment is 866 866-668-3625. And again, these are complimentary. It's an opportunity for you to take the guys and look, it's like a test drive. It's like, you're kicking the tires. You're going to see if you're a good fit for them and they're a good fit for you. 866-668-3625. So back to this. How important is this next point, Casey? And that's just choosing the right investments.
This is huge. I mean, this is monumental when it comes to retirement planning and making sure that you're going to be set up properly. And I think really, everybody, when we start talking about investments, everybody starts to think, okay, well, I really want to get as much return as I can. The reality of this is that there's a question that comes before that, and it's about how much time you have to be invested. Of course, you want to have as much return as possible. We want that for all of our clients. But there's something that holds people back from putting it all into a really aggressive stock, which is the potential downside, right? That's the reality. You have to be aware of both sides, and you have to understand how both of those things can affect you as you move towards retirement. So the time frame that you have is key. If you're 5 to 10 years from retirement, you do not have the time frame to deal with the massive market volatility like we're seeing right now, like we saw in 2000 and like we saw in 2008. Ultimately, those things can have a huge detrimental impact to your overall retirement success because you're taking unnecessary risk or even risk that you just really can't deal with at this stage of the game. So there's a few things to consider. We can start looking at mutual funds and ETFs. I think mutual funds are very well known. But ultimately, that may not be the best solution. ETFs do have typically a lower cost. They can provide that diversification that we're looking for. Not that mutual funds can't, but we want to be cautious and make sure that those are appropriate. I'm going to touch on the bad word real quick, annuities.
The A word.
Yep, here it comes.
Look out.
So that depending on what you're trying to do, an annuity could be a great option for you. Realistically, it's the same as any other investment. It does not fit every scenario. It is not the right thing for everybody. But in the right scenario, it's a great tool. And in some scenarios, it's the best tool. So it really depends on what you're trying to do. And then, of course, stocks and bonds, having the right basket of stocks, diversifying across bonds, making sure that you have that true diversification, that your assets aren't correlated, and really creating something positive for yourself as you move into retirement, and making sure that you've got things set up properly.
It's all about having that plan. We talk about it each and every week, and working with professionals, working with fiduciaries. Mark, we have 10 positions on the calendar with Elevated Financial Management. Walk us through what's going to happen for these 10 lucky callers.
So if you're listening today, pick up the phone, give us a call, because if you maybe you're working at Boeing or you've recently retired and you've saved at least $250,000 or more, these plans are going to work best for you. So we're going to have our team of certified financial planners look at your individual situation. Taxes are going to be a big part of what we look at. We're also going to look at maybe your medical part. What about, do you have anything in place when it comes to a trust or a will? What about taxes? As we mentioned, and income, is it guaranteed, going to be guaranteed forever? So please pick up the phone. Let us put a plan together that's going to make your retirement turn out to be what you always hoped and dreamed it would be.
All right, here's the number to call. Again, grab one of the appointments. They're complimentary. 866-668-3625. That's 866-668-3625. When we return, the closer we get to retirement, the more we need to make sure our plan is helping keep our money safe. We'll explain when we come back. Your Wealth. Your hosts are Mark Stimson and Casey Elkins. You can find them right here in Seattle. Elevated Financial Management, 42 years combined experience between these two, helping hundreds of their clients get ready for retirement. We're all headed there, folks. You need to have a plan. They are certified financial fiduciaries. If you have any questions about your own retirement situation, here on the program, we open up 10 appointments. They're complimentary. See where you are in your planning process. If you haven't started, get going. If you're in the middle of something, but you're confused, frustrated, not being communicated with, get a second opinion. The number? Well, we're going to put it out there for you. 866-668-3625. Grab an appointment now. 866 668-3625. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. So we wanted to kind of get into this. Let's break down how you can help make sure that your retirement savings are, in quotations, mostly safe no matter what happens. I mean, there's no 100% guarantees, but there are a number of things that you can do to really help out in this category. So, Mark, we'll start with you, and it's carefully select those investments. We kind of already talked about how you can do that, but you really need to kind of be dialed in here.
I really love what Warren Buffett, the point that he made where he said risk comes from not knowing what you're doing. Boy, is there some truth to that, especially when it comes to your 401k plan. Because we know that a lot of people set up their 401ks, they go to the rah-rah session in the cafeteria, and they don't look at it very much after that. And sad to say, a lot of 401k plans, not only do they not offer a lot of different type of plans, most of them are fairly risky options. And sometimes there's very few safe options. Now, some plans will offer some safe options, but you have to know what they are, right? If you're going to use them. So depending on your risk tolerance and where you are when it comes to age and your planning circle, you might say, that's going to help to determine how much risk that you are going to be wanting to take. Because a significant loss in the retirement red zone can be devastating if you're within 5 years. What if it takes 2.5, 3 years to recover from that or longer? See, those losses are what we want to avoid as we get closer to retirement. So that's something we all need to think about. Also, we're going to want to think about how can I decrease the volatility by diversifying. Some of us, and Casey knows this well too, some people come in and they'll tell us, oh, I got 20 different mutual funds and ETFs that I have, right? We analyze it for them and they think they're diversified. But what we end up finding a lot of the time is they have what's called overlap. The same mutual funds that they own, a different amount of those, they all have the same holdings. So if you have the same holdings inside that mutual fund, you're not really truly diversified. What's that mean? Well, when the market goes up, all the mutual funds are going to go up. And when it goes down, they're all going to go down at the same time. We don't want that. We want to have correlation to where they're moving at different times, right? And that's going to really help us, which is really going to bring us to a solid point we need to understand, Casey. And that, do you really know and understand your risk level?
Good one. I think this is something that is just missed quite a bit. I think people truly don't understand their own risk level. I mean, we see it all the time, right, Mark? You're talking about correlation. You're talking about overlap when it comes to the investments. And this is something that we work really hard to help clients understand the current risk that they're taking, right? As we've talked about, I mean, we help folks get retired and stay retired. And so with that, the risk that you're taking 5 to 10 years before you retire in the early stages of retirement, that is really, really key in making sure, one, that you understand it, and two, that it's appropriate, right? Yeah. Because your time horizon really has a big impact on this. If you've got a number of years before you retire, let's say 15 or 20 years, you have time to deal with hiccups in the market, downturns, those kinds of things. You have time to recover from that. But when it comes down to it, if you're 5 years from retirement and the market has an upset that lasts for a period of time, like we're dealing with right now, you may not be able to retire on time. You may not be able to take the income that you wanted to take in retirement if you're not invested the right way. And so you want to understand that. Now, when it boils down to it, many folks will look to bonds to create the safety in their portfolio. And that can help to some extent. But I will say that bonds did have a tough year last year, right, with interest rate hikes. So that doesn't necessarily mean that they are the safe haven that they once were, or that they're always going to be in the future. Now, it doesn't mean that we don't like bonds, right? We still do. Right. But ultimately, it has to be used in the right way, and you've got to be able to shift accordingly. In addition to that, as time goes on, and as you age, you want to shift to more conservative investments, right? The closer you are to retirement age, the more conservative your funds should be. We use something called the rule of 100. Mark, you talk about this a lot. If you're 100 years old, I'm sorry. Let's say you're 60 years old, we subtract that from 100, right? What that means is we don't want more than 40% of your investments at risk in the market. So we want your age, 60%, to be truly protected in a investment that can be safe and can be growing. And ultimately, that is what's going to help create that safety net and create the confidence that you need to retire successfully. You want to add something, Mark?
Yeah, I was going to say, Casey, this might be a really good time to share with our listeners. When Molly and Daryl came in and you did the analysis, what did they end up saying to both of us during that analysis?
Well, there was a lot, but one of the first things that comes to mind is one: why hasn't our current advisor showed us this?
Yep.
Right? What that's the biggest thing, I think. Really, they didn't know, right? They
Yep.
just didn't know. And Mark, you and I were not in the habit of advising people and telling folks what to do and how to make
Right.
changes without helping them first understand where they're at. Right?
Right.
That's really
Yep.
key. Because that's really it. Once we know where you are, and once you know where you are, then it becomes clear as to how we make those changes. And that's really an important piece to the puzzle.
I thought, part of that, when they basically said no one had ever shown them this before, I
Yeah.
thought that resonated with us. We talked about it after they left. How important is anybody listening? A lot of you probably have never had anybody take the personal time with you to really show you exactly what your investments are doing and how it works, and the amount of risk you're taking versus the amount of reward that you should be getting based on your risk. Very few people ever see this. So I just wanted to bring that up since we were talking about risk.
Yeah, I think it's an excellent point. There are probably a lot of listeners out there that feel like they've been talked at as opposed to talked with.
Oh yeah.
Yeah.
And you really, I mean, to get an education and to ask questions and get answers back to those questions, and also have some things posed to you that maybe you hadn't even considered. I mean, that's what the planning process is all about. That's the get to know you process. That's putting in that roadmap to get you to and through retirement. Here on the program, we offer up these 10 appointments for that very thing, and they are complimentary. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. And you can call right now and grab an appointment, 866-668-3625. You leave the checkbook at home. These are complimentary, 866-668-3625. Just have a conversation. You won't be talked at. You'll be talked with. And it's about having that plan. So going back to mostly save, how do we do it? Retirement savings, that's a big concern for everybody. Mark, short-term money. Emergency fund, got to have it.
Yeah, we consider this to be our yellow bucket of money. The yellow bucket is what we consider bank inventory, and we like to have a minimum of 6 to 12 months of liquidity at all times. So if a client says, Mark, I need $7,000 a month, we're going to take that times, let's say 12 months. They need $84,000 that's going to be liquid in checking and savings, right? Because life happens and we don't want to have to go to the red bucket, the money in the market, to get money maybe for a car or a roof or tires, whatever it might be. Because what happens if we sell that asset at a loss? We just locked it in. So we want to have plenty of liquidity. We don't, if the market does take a downturn and your 401k gets hammered, well, your yellow money is not going to be taking that kind of a hit. So you want to have money in these different buckets so that you can take money at different times based on what the market is doing. So you're going to be able to weather any type of financial storm that you might be dealing with. And that they are coming. Storms are coming. I mentioned the client that just was diagnosed with cancer, aggressive form of prostate cancer. Well, we had to change his whole plan. And so that's going to require sometimes more liquidity or maybe more income sooner than what we had expected. But we want to be able to make those adjustments and change the plan when life events happen, and they will happen. And so the big question is, do you have a plan that's going to allow you to make these changes so that your whole life isn't upended when maybe a life event that could be very discouraging or tragic happen? Do you have a plan to deal with it? That's the real question that needs to be answered.
Elevate Your Wealth. Your hosts are Mark Stimson and Casey Elkins. Again, you can find them right here in Seattle, Elevated Financial Management, talking about how you keep your retirement savings mostly safe with everything that's going on. We've been talking about inflation, market volatility. It's all there for you. But this last one, Casey, I'll have you jump back in. You don't want to do this, but a lot of people might be in this boat. Maybe you have to consider delaying retirement.
Yeah, that's really something that a lot of folks find themselves having to grapple with right now, right? Just because a lot of people have lost a lot of money last year. This year, the market's pretty flat. That volatility has lessened people's accounts, and because of that, they're not able to take the same income that they would have been able to. And so, with that, delaying retirement might be the solution. Now, we don't want that for anybody, right? When we're working with somebody, we look to help people get retired, stay retired. So that means not going back to work, right? But if you're in that circumstance, if that's where you're at right now, then ultimately that's why we offer the written financial plan to all of our radio listeners, because we know that's what's going to help people become retired, to stay retired, and be successful in their retirement. And so, Morgan, you mentioned something. You mentioned that people might feel like they're being talked at instead of talked with. I think that's really valuable. And I'll just say this, for those that are willing to pick up the phone right now and give us a call, we want to talk with you. We don't want to talk at you. If you felt like you've been talked at, if you felt like your advisor is talking over your head or explaining things and using lots of terms that you don't understand, you're not familiar with, that's okay. We're not going to do that. We're going to help you get a written financial plan put together by our team of certified financial planners. That plan will be custom tailored to you. It will help you understand what your retirement should look like, what it's going to look like, and it'll all be put together in a way that's easily understandable just for you.
All right, here we go. The number to call is 866-668-3625. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. And again, it's a conversation with. It's not being talked at. 866-668-3625. Secure one of those appointments now. 866-668-3625. When we return, we've got retirement scenarios. We'll see what the fellas come up with. Welcome back into Elevate Your Wealth. Your hosts are Mark Stimson and Casey Elkins. You can find them right here in Seattle, Elevated Financial Management. Check them out online. It is a great resource website, efmnw.com. All letters, efmnw.com. We get it. You're busy. If you're out and about, can't listen to the entire show, you can always check out the website, efmnw.com. Again, links to the TV show, radio show, and podcast form. A lot to do there, plus contact information if you have any questions about your retirement. And speaking of Mark and Casey, 42 years combined experience in the retirement planning business, and they've helped hundreds of their clients get ready for retirement. They are certified financial fiduciaries. I'm Morgan Patrick, consumer advocate, sometimes referee, as I like to say, between Mark and Casey. So we do scenarios. I'm going to throw these out. Casey, you're up first. How would you handle this? In 2 years, my wife and I will be 67 years old and be qualified to receive full Social Security benefits. We have IRA accounts with a combined value of over $1 million. How can my wife and I reduce income tax when we start to withdraw from our IRA accounts during our retirement years?
I'll say this, there's no time like the present. So if you're waiting until you've retired to try and start lessening your taxes overall, not that there's nothing to do, but there's less to do, right? So in advance, this is why we talk about this all the time. It's about planning. If you have more runway to retirement, you have more choices. Yep. And so if you've got a couple years before you retire, now would be the time to start looking at Roth conversion, right? Is that something that's going to be applicable in your circumstance? Is it going to be valuable? I've said this before, it doesn't fit for everybody. Not everybody should do a Roth conversion because depending on where your income is currently at while you're working, if you are going to have a reduction in your income when you retire, doing a Roth conversion at a higher tax rate now than what you're going to be when you retire wouldn't make a lot of sense. That being said, taxes, we all believe, are going to go up. So even if we are in a higher tax bracket now, if we think tax rates are going up, even though our income might be lower in the future, it could still make sense to do a Roth. So there's a lot of kind of caveats to this, right? Each direction has some other offshoots for it. And so this is why you've got to have that conversation with somebody that can help you navigate it, that understands that those tax rules, those tax laws, and understands your situation to help build something specific for you. Now, in addition to that, once you do start taking that income, once you get to RMD age, things of that nature, then you can start looking at QCDs, which is a qualified charitable distribution. That can be a way to lower your income tax. But it's important to remember that ultimately you are giving those funds away too. So if you're charitably inclined and you want to make that part of your portfolio, that's a wonderful way to go about it. But you got to, again, make sure that that fits for your overall plan. And make sure really that you have a plan, right? I mean, that's a big part of it, because if you don't have a plan, then it really doesn't matter. You want to say something, Mark?
Yeah, and then something else to think about too is there's some unique trust things that can be set up. We know there's what's known as a CRT, charitable remainder trust. So depending on your situation and where you're at and the amount of money that you're trying to protect, or you might have an estate tax issue. Again, this is why working with someone that can really help you on the tax side of things could make a huge difference. How many times do we talk about, okay, it's not how much you have, it's how much you keep.
Absolutely.
So critical to everything.
Yeah. So that really pulls us into our next question, Mark. I like this one here. It says, not going to lie, I don't know a lot about taxes or 401ks, just learning as I listen. So I'm struggling to understand the advantage. How does it help me if I still need to pay taxes when I withdraw the money later? Is there a strategy to this?
Yeah, that's a really good question.
It is, yeah.
Yep. And you know what? I don't want anybody to feel less smart about this, right? Because they're probably thinking the same thing. Well, a 401k, if you have the ability, one of the best parts about a 401k is if the company is matching, that's free money. That's money that the company's going to put in because you have been willing to pay yourself. So how much better does that get? So you want to maximize that. The other thing that a 401k will do for you is allow the magic of compounding interest. That really matters, because if you pay tax as you go, those dollars that you send to Uncle Sam each year don't stay in your account and build up. And that's what you want to be able to do. You want them to stay in your account, compound. That's why you'll have a lot more in a tax deferred account on the back end. And you are right. You are going to have to pay tax, but you're going to have a lot more money because of the compounding that those dollars had time to be used, to accumulate. So again, you want to be able to do that. So again, 401k, maybe you don't have that. So you'll set up an IRA. And maybe if you don't have that ability to have a match, you're going to be able to set up a spousal IRA for your spouse as well, if you're fortunate enough, or have one. Some may not consider that a good thing, but most of us do. So again, you can set up these accounts that's going to help you on the back end when you need the money for retirement, income that you can count on. So this type of planning is really, really important. You want to take advantage to this because it does matter. But I love the Roth too. What about setting up a Roth account where you can not get a deduction the year that you make that contribution, but all the growth is yours. It's 100% going to be tax-free when you retire. And that takes us to another item that doesn't get talked about very much, but is very powerful in creating tax-free income. And that could be the right type of life insurance can be used to create a wonderful bucket of tax-free money. And you're not held to the income limits that we have with a Roth account. Many of us might be not able to use a Roth account because we make too much money. And so a Roth is not an option. But those rules don't apply when it comes to the IUL, the Indexed Universal Life Policy. It's like a Roth on steroids. So that's really something you really want to think about learning about and possibly employing if you're trying to figure out some ways to build wealth and to build your retirement bucket.
Worth a conversation. And here on Elevate Your Wealth, powered by Elevated Financial Management here in Seattle. Of course, that's where you can find Mark and Casey. the opportunity to get on their calendar. It's complimentary. If you've saved $250,000 towards your retirement, these strategies are going to work best for you. You can grab an appointment right now by calling 866-668-3625. If you have any questions about what the fellows have been talking about, and it's always retirement, but there could be something that you are doing within your plan that maybe you just want to talk about. There might be an opportunity to pivot, be open-minded, but have that conversation. Again, if you haven't started planning, you're sitting on that portfolio, or if you're in the middle of something, need a second opinion, that's what these appointments are for. 866-668-3625. All right, next scenario. Casey, to you. When you withdraw monies from a 401k plan, pay the taxes, and reinvest the balance into a Roth, is there a waiting period of 5 years before the profit is tax-free? Also, if you do this yearly, must each conversion amount be held for 5 years? Or once the Roth 401k is open, is it only 1 5-year period? So some questions wrapped in there.
Yeah, pretty straightforward answer. Realistically, the money does have to be there for 5 years before you can take it out, before you can take the growth out tax-free. So barriers of entry or things to understand when it comes to a Roth account. We've got to leave the investment there for 5 years or more to be able to get that tax-free growth. We have to be over the age of 59 and a half to pull the money out. So that's the same as in a 401k or an IRA. That also applies to a Roth account. Now, if you did need to take money out in that 5-year time frame, let's say you're 62 and you just put the money into your Roth, you can take that money back out without a penalty if it's the original amount that you put in. It's the growth that can't come out during that 5-year time frame. Now, I'll just say this. That would be a last resort, right? You don't want to take money out of a Roth account that you just put into it because you're really not getting any benefit from that tax-free account. Yeah, you're defeating the purpose, exactly. So that's something to consider. Now, if you do have multiple conversions or you've contributed to a Roth account at different times, each contribution, each conversion does have its own 5-year time frame. So we can't start a Roth account now, or we couldn't have started a Roth account, let's say 10 years ago, and then do a conversion now, and then 3 years from now, pull out the growth from that most recent conversion without paying taxes. We'd have to wait 5 years for that most recent conversion. So it's tracked based on the dollar that was contributed. It's not based on the opening of the account. Now, that can get kind of complicated, and that's why sometimes folks will have multiple Roth accounts so that it's easier to track when those conversions happen, and that's something that we employ here in our office to keep it simple. But that is definitely something that you can do.
Last scenario. And seeing a lot of this lately, guys, and you guys can both jump in, make some quick comments. The robo-advisor, the digital age, the AI kind of taken over. It's all over the place. Should people look into it?
Yeah, this is something that we truly believe. That's why we love people to come into our office. I will never go away after almost 40 years of this now, of wanting that handshake, that eye-to-eye contact, because a robo-advisor cannot do the same things and feel the emotion that a client is going to have with different subjects that we're having to deal with. It could be, how do I help take care of my mother or my grandmother in long-term care? How do I get the income? Now, a robo-advisor could give you the numbers and say, okay, we're going to create this and it's going to be just fine. Don't worry about it. Well, we don't believe that. There's so much more to coming down the mountain and retirement planning that a robo-advisor will never be able to do. And so we have a very unique niche. We have a little boutique practice here that we are so grateful to be a part of people's lives, our clients' lives. They become our friends, and we're able to help them with all the emotional things that they're going to deal with. Because Casey and I find that one of the hardest things for any client that's been a good saver is to become a good spender. Mm-hmm. And how's the robo-advisor going to help you with that? Besides just tell you, oh, you could spend this amount of money. No, there's so much more to it than that. And so we don't believe a robo-advisor will ever completely replace a good distribution planner. It'll never happen. Not in my lifetime, I don't believe. And I think anybody that really wants the hand-holding, the guidance, the education We'll never get that from a robo-advisor. So we believe we have a safe niche, you might say, that we're very confident it's going to be here for a long time.
All right. Well, we've got 10 appointments available, again, at Elevated Financial Management. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Call now. Grab an appointment, 866-668-3625. They are complimentary. Again, 866-668-3625. Well, another edition of Elevate Your Wealth is in the books. For Mark Stimson and Casey Elkins, I'm Morgan Patrick. We'll see you on the radio next week.
Investment advisory services offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.